Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of equity value versus enterprise value, what they mean and how to use them. Understanding the difference between equity value and enterprise value is essential for making smart financial decisions. These two metrics are at the core of company valuation, yet they serve different purposes and answer different questions. Whether you're analyzing investments or assessing a company's worth, knowing how and when to use each can give you a clearer picture. In this video, we'll break down what each term means and how they work together to help you evaluate businesses with confidence. Defining equity value. Equity value is a fundamental concept in company valuation. Also referred to as market capitalization, it reflects the value of a company based on its shareholders' ownership. Essentially, this is the portion of the business that belongs to stockholders after accounting for debt and other obligations. Understanding how to calculate and break down equity value is crucial when comparing companies or making investment decisions. Equity value formula. Explain the formula used to calculate equity value. The formula to calculate equity value is straightforward. Equity value equals current stock price times total outstanding shares. This equation uses the stock market's perspective to determine the value of all outstanding shares at the current trading price. This number is often reported as a company's market cap and serves as a key metric for public companies. By multiplying the stock price by the total number of shares, you're effectively gauging how the market values the company's equity. However, it's important to remember that this figure doesn't account for broader debt obligations or potential cash reserves, which are considered separately in enterprise value calculations. Components of equity value. List and describe the components that contribute to equity value, such as stock price and outstanding shares. The calculation of equity value is simple, but understanding its components can help you analyze how it fluctuates and why it matters. Here are the key contributors. Stock price. The current trading price of a single share of a company's stock. Since stock prices can fluctuate due to market trends, company performance, or investor sentiment, the equity value is dynamic and changes in real time. Outstanding shares. These are all the shares of a company that are currently held by shareholders, including restricted shares and shares held by institutional investors. Outstanding shares exclude treasury shares, which the company holds in its own reserves. In essence, equity value is the product of these two components. If either the stock price or the number of shares changes, the equity value shifts accordingly. For instance, if a company issues new shares, its equity value increases because the total outstanding shares grow. Similarly, a rise or fall in stock price directly influences the overall valuation. By keeping an eye on these components, you can better understand how the market perceives the company's worth from an equity standpoint. Equity value is a snapshot of shareholder wealth, making it a vital metric for investors and analysts alike. Defining enterprise value. Enterprise value, EV, is a comprehensive measure of a company's total value. While equity value focuses solely on shareholder ownership, EV provides a more complete picture of a company's worth by factoring in both its capital structure and financial obligations. Investors and analysts often rely on EV to evaluate the true cost of acquiring a business, as it accounts for debt, cash, and other factors beyond equity. Let's break it down further. Enterprise value formula. Explain the formula used to calculate enterprise value. The formula for calculating enterprise value is as follows. Enterprise value equals equity value plus total debt, cash, and cash equivalents. This formula essentially adjusts the company's equity value by incorporating its financial obligations and available liquidity. Here's a quick explanation of each component. Equity value. The market value of all outstanding shares, as explained earlier in this video. Total debt. This includes both short-term and long-term debt obligations that a company owes to lenders. Cash and cash equivalents. Liquid assets such as cash on hand or marketable securities are subtracted since they reduce the net cost of acquiring the company. Why subtract cash? Imagine you're buying a house. You'd consider the mortgage you'll take on, debt, but if the seller throws in cash sitting in the house, that reduces your actual cost. The same logic applies here. cash lowers the effective cost of the business. This equation gives a more holistic look at a company's value by factoring in its financial health, making it a go-to metric for many professionals. Components of enterprise value. List and describe the components that contribute to enterprise value, including debt and cash. Enterprise value captures more than just equity, it takes the entire financial structure into account. Here are its key components. Equity value. As noted earlier, this is the total value of a company's shares as determined by the stock market. It's the starting point for calculating enterprise value. Total debt. This includes all types of borrowing, such as bonds, loans, or credit facilities. Debt obligations represent financial commitments that a buyer would inherit if they acquired the company. This is why debt is added to equity value in the formula. It must be accounted for in the overall valuation. Cash and cash equivalents. Unlike debt, cash is a valuable asset that offsets liabilities. Companies with significant cash reserves may have a lower EV compared to a similar company with little cash. Cash equivalents also include marketable securities that can be quickly converted into cash. Other potential components may include preferred stock. If present, it is added because it represents ownership obligations not captured by common equity. Minority interest. This reflects the ownership stakes in subsidiaries that are not fully owned by the company. Together, these elements create a well-rounded view of what the company is worth to all stakeholders, not just shareholders. If you only looked at equity value, you'd miss critical details like outstanding debt or the cushion provided by cash reserves. Enterprise value ensures nothing is overlooked, making it a powerful tool for valuations, mergers, or acquisitions. Key differences between equity value and enterprise value. When evaluating a business, one of the most common areas of confusion lies in distinguishing between equity value and enterprise value. While both are essential tools for understanding a company's worth, they provide very different perspectives based on what they include and exclude. To make these distinctions clear, let's break down the key differences across several critical areas. Capital structure impact. The capital structure of a company, the mix of debt, equity, and other financing sources, directly impacts both equity value and enterprise value but in different ways. Equity value is influenced solely by the equity component of the capital structure. It reflects the market value of the shareholder's stake in the company, ignoring debt or cash positions. For example, if a company issues more shares, its equity value increases proportionally, regardless of any changes in debt. Enterprise value, on the other hand, incorporates the entire capital structure. It adjusts for debt, adding it, and cash, subtracting it, to give a more inclusive view of the company's value. Debt-heavy firms will naturally have a higher EV relative to equity value, while companies with large cash reserves will see the opposite effect. Think of it like buying a used car. Equity value is the sticker price you see, while enterprise value considers additional costs like unpaid loans on the car and any cash left in the glove box. Both are important, but they tell different parts of the story. Valuation perspectives. The purpose of each valuation metric also plays a major role in how investors and analysts view them. Equity value is the go-to metric for understanding what shareholders own. It's useful for stock market investors who want to see the market's valuation of their equity stake. For instance, when assessing whether a company's stock price is undervalued or overvalued relative to its peers, analysts primarily look at equity value. Enterprise value, however, is a broader metric often used in mergers, acquisitions, or other strategic deals. It answers the question, what does it really cost to acquire this company? By accounting for debt and cash, it offers a clearer picture of the company's true financial obligations and resources. For this reason, EV is favored for calculating valuation ratios like EV, EBITDA, which gives a more apples-to-apples comparison across companies with varying debt levels. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.